Professor Gonri, Chair of Advisory Board, Indonesian Finance Association, Professor Eduardus Tandelilin, President of Indonesian Finance Association, Professor Irwan Adi Ekaputra, Board of Indonesian Finance Association, Board of Commissioners and Directors of Self-Regulatory Organization, stakeholders in the capital market, and all of the invited deans, lecturers, students, and academics. We are very much delighted to be here again today to continue with our conference today. We still have parallel sessions until 5 p.m. Indonesian time today. And to start the day, we will have the president of Asian Finance Association, Professor Robin K. Chow, to present the national culture and the asset growth effect, insights from the overinvestment hypothesis. So please welcome the moderator for the session, lecturer of Universitas Gadjah Mada, Mr. John Eddy Junarsin, PhD. The time is yours.
Thank you, Santiana. Good morning, ladies and gentlemen. Nice to see you again on the second day of the conference. And it's already the sixth Indonesian Finance Association annual conference. uh, it's just so unfortunate that this year we could not meet in person because of the pandemic. But we have seen that the enthusiasm, the interest, and also the research atmosphere do not dissipate at all. That's, I think, the positive things that we could see and experience this year. So good morning again to our guest speakers, distinguished speakers, Professor Robin Chow, Professor Gondwi, Mr. Inarno, the President Director of Indonesian Stock Exchange, Professor Irwan Adi Ekaputra, the Chair of the Indonesian Finance Association, Professor Edward Tandelilin, the Chair of Advisory Board of the Indonesian Finance Association. So, as mentioned by Tantiana, today we have the President of the Asian Finance Association, Professor Robin Chow, and in a little while we'll see his presentation and also explanations about his latest research, I think co-authored by also Professor Gonri. So without further ado, I'll read quickly Professor Robin Chow's resume, the brief resume. He's the president of Asian Finance Association. He's now the professor and also vice dean of the Department of Finance at the National Cheng Chi University in Taiwan. He's also in the editorial board of the Journal of Futures Markets, and his research interests are corporate finance or financial management, market microstructure, and behavioral finance. And today, he's going to deliver a presentation on the national culture and the asset growth effect, insights from the overinvestment hypothesis. So, yeah, I hope you enjoy today's session. And at the end of his presentation, you could write down your questions, or yeah, I think that's the best way. You could jot down your questions in the chat room, and I'll try to select some um, most relevant questions, considering that we have limited time as well. But if we have you know extended time later, then we hope to accommodate as many questions as possible. So yeah, again, I will hand in the time to Professor Robin Chow. Enjoy. Thank you.
Thank you. So let me share my slides. So can everyone see my slides?
Yes.
Yes. Okay.
Yes.
Good.
Yes.
Thank you, John, so much for the kind introduction, and I'm really honored to be invited by Professor Irwan Ekaputra and Professor Ted Liding to be plenary speaker of this conference. So this is a joint work with Professor Gong Ri, who also had another presentation yesterday. And the other co-author is my student who's currently a professor in National China University in Taiwan. So let's start with the title. of the paper and I'll give you a rough idea about what we are trying to figure out in this paper. So we try to test the asset growth effect in an international setting. And why is this interesting? Because literature has found that the amount of investment is actually negatively related to future stock returns. And when this is first discovered, it's somewhat surprising because we would usually expect that firms to invest when the future prospects are good. So the investment, intuitively, the investment should be positively related to future returns. But this is not what found in the US. And later on, scholars have tried to expand the research scope to an international setting to see whether this so-called asset growth anomaly or asset growth effect is a universal phenomenon across countries. And the answer is yes. For most of the countries around the world, the corporate current investment is negatively related to their future returns. So there have been various explanations and hypotheses trying to figure out why this is the case. In this paper, we bring in national culture, which is, personally, I believe is an interesting topic because we know that cultures are vastly different among different countries. And there have also been research and papers on talking about how national culture will invest corporate investment, financing, and dividend decisions, as well as how national cultures will affect individual investment behavior. So this is more of like a paper originating from behavioral finance perspective and try to propose that the national culture, certain aspects of national cultures would affect the asset growth effect and through the over-investment hypothesis. I'll explain about the over-investment hypothesis in detail in a few minutes. So let me start by talking a little bit about the asset growth effect. So as I said, it has been documented there is a significant negative corporate investment return relation. And initially, this is quite surprising. As I say, people tend to believe that a corporate invests in good times and the future returns should be positive. And this is first discovered by Baker, Stan, and Wugler in 2003 from the US data. And later on, scholars try to propose hypotheses or explanations, try to figure out why this is the case with the US data. And recently, some other scholars, they expand the research scope to international settings or international data, and they found that the asset growth effect is also significant across different countries. And in this paper, we are a little bit hesitant to use the asset growth phenomenon anomaly, because there is argument in the literature, talking about whether this effect, asset growth effect, is rational or irrational. So we try to avoid the use of anomaly. Okay. So let me proceed to the next slide. So in this paper, let me talk about the hypotheses that have been proposed in the literature. So there are three lines of possible explanations on why there would be a asset growth effect. The first is called overinvestment hypothesis. This is quite intuitive, when investments are increased due to overinvestment or overconfidence of managers, then the future stock returns are bound to decrease because the investment will just be wasted and will be invested inefficiently. So this is called overinvestment hypothesis. And we'll mostly perform our research based on this overinvestment hypothesis that's derived from national cultural differences, which I'll explain in a minute. And the second is called the limited arbitrage explanation or hypothesis. Uh, some researchers, they find that this asset growth effect is stronger among stocks with higher arbitrage costs because these scholars, they believe that the asset growth effect is actually an anomaly. So if it's an anomaly, then this anomaly will be stronger for stocks that are harder to arbitrage. So for example, for stocks those stocks that are young, didn't pay dividends or have high stock volatility and so on and so forth. And the last one would be a rational explanation. It's called the Q theory. As a finance scholar, we all know that the cost of capital is the other side of cost of capital is the expected return of investors. So if managers are rational, they tend to invest when the future expected cost of capitals are low, right? So if future cost of capital is low, then the future expected stock returns will be low. So this is in the Q theory perspective, this asset growth effect is actually not an anomaly. It's rational because managers tend to align corporate investment when future expected return is low. That's why we find there is a negative relation between asset growth and future stock returns. So there are various, arguments and hypotheses that have been proposed in the literature, and this is an ongoing debate. Okay. So what have we done in this paper? Sorry, let me talk about how to distinguish the explanations in international equity markets. So there have been some efforts to try to distinguish between different hypotheses. So for example, scholars have tried to distinguish between Q theory versus overinvestment by including market development. The hypothesis is that if market is well developed, then managers and investors will be more rational. So the Q theory will be standing out. So the hypothesis that in more developed market, the Q theory will dominate. In less developed market, then over investment hypothesis will dominate. And the second explanation is try to distinguish between Q theory versus limits to arbitrage. So the story is simple. When market is more efficient, then Q theories will win out. But if market is less efficient or if market is inefficient, then limits to arbitrage will appear. Then the anomaly will be stronger in markets that are less efficient. So this is called the limit to arbitrage hypothesis. So scholars have tried to look at markets with different efficiencies and try to distinguish between Q theory versus limits to arbitrage. And finally, there are various alternative forms of mispricing. For example, markets have different degrees of investor protection, different degrees of corporate governance, accounting quality. So if we can separate international markets into different groups of investor protection, governance, and accounting quality, then we can try to figure out which are the more important factors that are driving the asset growth effect. So what have we done in this paper? Uh, this paper, well, the topic is not entirely new. And what we have done in this paper is try to bring in national culture into the setting and try to show you that the national cultures are important factors that are driving asset growth effect. And it's so strong, these national culture factors are so strong, they can even subsume other factors that have been proposed in the literature. So we basically focus on two aspects of national cultures. The first one is the overconfidence factor. The idea is simple. When managers are more overconfident, then they'll invest more and invest efficiently. So from the literature, we can find the overconfidence index for different countries, different overconfidence indices for different countries. So the hypothesis would be managers that are located in relatively more overconfident countries, they'll invest more and the asset growth effect will be stronger. I'll go back to the hypothesis again in next slides. So the second important aspect is called the uncertainty over avoidance. So if managers are more uncertainty avoidance, they try to avoid uncertainty, the tendency is stronger, try to avoid uncertainty, then they will mitigate overinvestment. That means they're more conservative, so they invest less. And it's actually good for the firm because managers are more risk averse. Then the asset growth effect uh, will be uh, will be less or will be mitigated. So these two psychological dimensions would serve as proxy for the overinvestment hypothesis. So let me explain the hypothesis in more details. So the first one is called managerial overconfidence will enhance overinvestment. So the empirical findings that are consistent with this hypothesis would be the asset growth effect is going to be stronger in individualistic cultures because managers in more individualistic cultures will invest more. If they invest more, they tend to overinvest. If they overinvest, then the investment or asset growth will be negatively related to their future stock returns. So that's the first hypothesis. And the second one is that uncertainty avoidance will mitigate overinvestment because managers in more uncertainty avoidant countries will tend to invest less because they are more risk averse. If this is true, then the asset growth effect will be stronger in low uncertainty avoiding cultures. Or in other words, asset growth effect will be weaker in high uncertainty avoiding cultures because managers in uncertainty avoiding cultures tend to invest less, then the asset growth anomaly or asset growth effect will be weaker. Okay, and finally, um, we will show that the national culture factors are so strong they can subsume market development and other efficiency factors in explaining asset growth effect. So we show this by running various multiple regressions, and those regressions will show that our national culture factors are actually the strongest factors among all factors that have been proposed in the literature. So we'll use cross-sectional regressions to show that our hypotheses are stronger or our factors are stronger actually, right? So let me proceed to talk about the data and variable constructions. We have a sample consisting of all common listed stocks from 41 countries around the world. And because due to data constraints, it's very difficult to include stocks from all countries because some countries, they just don't have enough data to be tested. So the 41 countries are almost the best we can do. So we have monthly market and accounting data for international markets obtained from data stream. And the US data will be obtained from CRISP and CompuStat. And let me talk about the US data first, because US data is the most complete data set. So the number of firms are the largest for US data. So one potential criticism is that the US results will dominate the international findings because the data set is just much larger than the other countries' common stock data set. So in later tests, we'll exclude the US data and show that our the results still hold with and without the US data. And we obtained the country level individualism, uncertainty, and avoidance indices from Hofstede 1980 and 2001, and supplemented by Hofstede and Minkoff 2010. And these two papers, well, actually, these three papers are the most commonly used in the literature, not just finance, also in management. When people, try to figure out the differences among national cultures, they rely on the survey of these three papers. So these papers are commonly used in the relevant literature about national cultures. And because national cultures, they tend to be very stable, they don't change too much. So the survey, even though it's somewhat outdated, but still people use it because it's hard to believe that national cultures will change overnight. Okay. All right, this is the measurement of asset growth, and asset growth is simply measured as the total asset difference in total assets of two different periods divided by the total assets of previous period. And this is called total asset growth, right? And what has been found in the literature is that this total asset growth measure is negatively related to stock returns. Okay, this is well established in the US and around the world. And so people try to figure out why when you invest more, then your future returns are actually lower. And we'll follow Pharma and French closely in constructing variables such as firm size, book to market ratio, and we'll also use the past return as a proxy for momentum to be included in the Pharma Macbeth regressions. So all returns are converted to US dollars because different countries have different currencies. But this will not affect our results materially because later on, we also use the local currency returns to reperform all of our tests, and the results are pretty similar. Okay, so let me see if I can share with you my paper. Just can you give me a second? Let me bring up my paper. Yeah. Okay. So this is the original paper. If you're interested, I can send you the paper after my talk. I would like to show you a figure that I didn't include in my slides, which is there should be a overconfidence score and uncertainty avoidance score here. Oh, here. Okay. Let me show you the asset growth premium ranked by individualism. So the countries to the left is the most collective country. So if you can see it, Indonesia is all the way to the left, meaning that in the survey, the Indonesia is the most collective countries that have been surveyed. And not surprisingly, US is all the way to the right. So the US is the most individualistic countries around the world. I think that's also understandable. So if you can see that the asset growth premium fluctuates a lot among different countries. So for example, for US, the asset growth effect is strongest I'm sorry, not the strongest among all countries. Actually, these are stronger. But because finance, as a finance scholar, the things we're talking about is on average. It's very difficult. People always ask me why there are so many variations, and it's really difficult to explain. But the thing is, if you could look at the different country among countries, the individualism tend to be positively correlated with the asset growth effect. So this is the first impression. This is only it's more of like a univariate test that's visualized that individualism is actually positively related to asset growth effect. So this is what has been established in the literature. And what about uncertainty avoidance? For uncertainty avoidance, the trend is exactly reversed. So let me see if I can find Indonesia here. Sorry. Oh, here. Indonesia is somewhat to the left, meaning that it's tend to be more uncertainty avoidance than the countries to the right. Okay, and the country that's the most uncertainty avoidance is Singapore, and Greece is on the other side. So these are the national cultural aspects that have been derived from previous surveys. So as you can see here, the trend for individualism and uncertainty avoidance are exactly the opposite. So this is the first evidence that support our hypothesis. But of course, this is not good enough because we also need to show that the results will hold in a multivariate setting. Okay, let me go back to my slides. Okay. All right. So okay. So this is the univariate test that the first set of tables and I try to summarize here, that we have equally weighted returns and value weighted returns. The results are similar, so I'll focus on value weighted returns. So what you can see here is for low individualistic countries, the AG1, which is the firms that have the least asset growth rate, okay, that have invest less, or straightforward, these firms invest less. And these firms, AG10, those are the firms that invest the most. So we group firms into deciles. Those invest least and those invest the most. So those invest the most tend to have higher returns, but those invest the least tend to have relatively lower returns. This is in contrast with the literature findings, but remember, these are for low individualistic countries. So for firms that are in high individualistic countries, that actually firms invest more tend to have lower returns than firms that invest less. So the difference is positive. If you take the difference between AG1 and AG10, the difference is 0.633% per month. So this is statistically as well as economically significant. So what we try to show is this number in red. This is somewhat like difference in difference tests. So we have difference between AG10 and AG1 and try to be certain that the asset growth effect exists. And this only exists for high individualistic countries. And the difference between high individualistic countries, the asset growth effect between high individualistic countries and low individualistic countries is 0.745% per month. And again, both statistically and economically significant. So if you would like, you can focus on the number to the lower right. This number indicates that firms that are located in high individualistic countries, they tend to have higher asset growth effect or more significant asset growth effect. So this is the first set of results that showing the asset growth effect is actually stronger for high individualistic countries. And what about uncertainty avoidance? As I said, for uncertainty avoidant countries, this is the uncertainty avoidance index, okay? So this uncertainty avoidance index, what you can see here, let me take this high individualistic country as an example. As you can see here, for firms that are more highly uncertainty avoidance, okay, means that those firms, the managers tend to invest not overconfidently. So the AG10 is actually higher than AG1. This is the reverse of asset growth effect. So firms that are located in high uncertainty avoidance countries, they're, well, I hate to say they're more rational because we're not talking about rationality versus irrationality. But the thing is, the asset growth effect is reversed, exactly the opposite to overconfidence. So if you take the difference between low uncertainty avoidance countries and high uncertainty avoidance countries, the difference will be negative 0.692% per month. Uh, put it in economic terms. Managers in low uncertainty avoidance countries, they tend to not overinvest. So when they invest more, the asset growth effect is not strong, or even they can be reversed. Okay, so this is in contrast to the individualism and asset growth anomaly. Okay. So these are the two basic results, and of course, these results are not good enough. We need to do a series of robustness tests. So we exclude the U.S. market data, and the results are similar. We also partition our data by 1999, which is about around the time right before the internet market crash, internet bubble crash, and also it's about half of our data period. So the results are again similar, and also we calculate returns in local currency terms, and the results are similar. Okay. And next, we provide some future evidence on the overinvestment hypothesis across countries. So again, I'll focus on this value-weighted returns. So what you can see here is okay, let me explain why we have this set of table first. And from the literature, as it has been pointed out that firms with low debt ratio tend to have more discretion in investment decisions. So in other words, firms that have low debt tend to overinvest. So the asset growth effect will be stronger for firms that are less levered or have less debt. And this is exactly what we find. We separate firms into different leverages. So firms that are lower levered, the asset growth effect is stronger. Okay, is stronger for individualistic cultures or individualistic countries. For uncertainty avoidance, the results should be reversed. I'm sorry, the returns should be reversed. So the returns are negative, which is in the right directions, but the results are not as strong as individualistic culture factors. So we still find that the low debt ratio and medium debt ratio firms, they tend to have stronger asset growth effect, but it's not the strongest for the lowest debt ratio firms. So again, overall, the results are still there, just not that it's not a monotonic relationship. Okay, so again, lower debt firms, medium debt firms, low debt ratio firms, they tend to have more significant asset growth effect. And this is consistent with the hypothesis in the literature. So let me summarize the previous results, okay, before I go one step further. So basically, firms in individualistic countries, they tend to overinvest and the performance are going to be worse because they invest inefficiently. But for managers with more uncertainty avoidance, they tend to overinvest less, or they tend to invest less. So the asset growth effect will be gone or even be reversed, okay, in the exact opposite to what have been found in literature. So in our previous results, these are actually the main results that most significant results we can find, and they are consistent with our hypothesis. The first hypothesis is individualistic firms, they tend to have higher asset growth effect, and uncertainty avoidant firms, they do not have a strong asset growth effect, where the strong asset growth effect can even be reversed. Okay, so these are the major results. Okay. And next would be Fama-Macbeth regression. Uh, because for previous results, we separate firms into deciles, or group firms into deciles. So in this table, we use the continuous variable. This is the one plus, on the first variable is one plus the total asset growth rate. So the hypothesis would be this: firms that have more growth or higher growth in total asset, their future returns tend to be negative, especially for high individualistic countries. And this is exactly what we find. Okay, so again, this is consistent with our previous hypothesis. Okay, and for uncertainty avoidance, again, in high uncertainty avoidance countries, the asset growth effect will be less significant or even be reversed. So the difference is positive. Okay, and in low uncertainty avoidance countries, the asset growth effect is still very strong. Okay, so these signs and significance are all consistent with our first two hypotheses. And next, we add a bunch of different variables, other factors from the literature, trying to show you that our results are robust to other possible explanations or alternative explanations. So we took market development variables from Tipman, Wade, and Shi, 2013, including market development, access to equity market index, market cap to GDP ratio, and ratio value traded to GDP. So all these variables are related to market development. And we also bring in some market efficiency variables, for example, stock return synchronicity, importance of stock market, and future earnings response coefficient. So all these variables are well established in the literature. What we did here is just try to include those variables that have been proposed in the literature. So it's more like a horse race, okay? If you want to look at that way, it's like a horse race between our variables or our proxies with the proxies that have been proposed in literature and try to see whether our variables add marginal explanatory power to the asset growth effect hypothesis. I apologize for the small font of the table, but you can only focus on the coefficient that are highlighted. So these are the univariate regressions, okay? So we put in these variables one by one first, okay? Try to see which variables have more explanatory power. And what we find here is whether it's equally weights or value weights, our individualistic and uncertainty avoidance index are all very significant with the consistent signs and the significance. So these again support our first two hypotheses. And if you put in different variables in a univariate regression framework, some of the other variables are significant and some of those are not, okay? And let me focus on the value weighted portfolio here on the bottom, on panel C, okay? So these are the multiple regressions. So what we did here is we use our individualistic variable and uncertainty avoidance variable together with other variables one by one. So the takeaway from this table is our two proxies are almost always significant with the correct signs. But the other variables, their significance or disappear. In univariate framework, for example, equity obtain positively significant coefficients. But when they are uh, put in the regression together with our two proxies, the significance of equity has all but gone. So this again, shows you that our proxies, national cultures proxies are very significant in explaining the asset growth effect across different countries, right? So this is the market development variable. And we also control for a bunch of other variables from literature, okay? So these are more related to market efficiency. So for example, this is trading cost, idiosyncratic risk, dollar trading volume, whether stock market can be shorted. This is a credit, let me remember. This is creditor protection, and this is the anti-director clause, and this is, what's this? This is, I can't remember, I have too many variables. This probably the, let me figure out if from the paper, I'll talk, if you're interested, I can flip into the paper and talk about this later. But these are all the efficiency, market efficiency proxies. So this is accounting quality. This is the legal origin, whether the firms are located in UK origin, France, the legal origin, Germany, or Scandinavian law origins. So oh, this is earning management score, I remember, this earning management score. So all these are related to market efficiency of a certain country. So in a multiple regressions, some other variables are still significant, but the thing I would like to point out is that our individualistic measures and uncertainty avoidance measures still obtain significance and incorrect signs, okay? So conclusion is actually simple. We establish a significant linkage between national cultures and asset growth effect. So we propose that overinvestment as a underlying channel. So asset growth premia are significant in countries with high individualism and low uncertainty avoidance. So let me repeat this again. Managers in high individualistic countries tend to overinvest. So when they invest more, their stock price perform worse. And similarly, managers in low uncertainty avoidance countries, they also tend to overinvest, and their investment results are reflected in stock returns. So their stock returns are going to be perform worse, okay, because they tend to overinvest and they are low uncertainty avoidance, low uncertainty avoiding. Now, finally, so we find that the national cultures dominate other proxies for Q theory and limits to arbitrage in explaining the asset growth anomaly across countries. So, put it simply, because there have been no studies trying to bring together asset growth effect and national cultures. And personally, I'm very interested in how national cultures would affect the corporate decisions and investor decisions. So in my own opinion, I think this is a very interesting work. And of course, there are other things that we need to do. So for example, we haven't clearly established the link between national cultures and investment, the amount of investment. One way to do it is to follow Momentier and Tate try to test whether overconfidence will affect the cash flow and investment sensitivity across countries. So the hypothesis is simple. Firms that are located in more overconfident countries, they tend to invest when they have cash, and they tend to invest more when they have cash. And then they tend to invest less when they have less cash flow. And this is due to overconfidence that have been shown in Momentian tape. So we haven't really clearly established the first link. Now we are talking about the a bit more indirect link, the link between national cultures and stock returns. But what we can do next is to try to link the national cultures and investment or overinvestment itself. And that will make our paper more complete. But we're really happy about the results that we're getting so far. Okay, right? So I think that's pretty much I would like to share. Thank you, John.
Thank you, Robin. It's an excellent piece of work by Cho, Ko, and we. That you have three co-authors here, and I think we'll open the question and answer session to
Okay.
224
Two.
attendees right now.
Okay.
So let me see here. Okay, so I'll take the first question by Rita Juliana.
Mm-hmm. I'm reading it.
Yeah, you're reading it also.
Okay.
So according to the Hofstadter UAI data, US has lower UAI. We can say they're more towards overconfident. Do you also find that the US
Okay.
asset growth also is also higher
Firms
than that in other
located.
countries? Yeah.
Okay. Uh, Let me bring up my paper
Mhm.
again. Let me show. Okay, just a minute. Yeah. Okay. Uh, this is what I said. Because it's really difficult to pin down the result to a single factor. So, for example, if you look at this figure, the U.S. The individualism index of U.S. is all the way to the right. So this is consistent with our general perception. But the thing is, the asset growth effect is not the highest in the U.S. It's actually, if you look at this figure, I think it's the highest for India. So people always ask me the question, as I said, a few minutes ago, and why would there be so much variation among different countries in terms of asset growth effect? Uh, the answer would be because it's really difficult to control for other relevant factors. So this is a shortcoming of the paper, I would say, but it also opens up a lot of research opportunity for future researchers because there are so many variations. It's really difficult to pin down to a certain or a set of few factors. So there are so many other factors that we haven't known now. So we should, if for those who are interested, this is you can see this as an opportunity for future research. Try to figure out what are the other relevant factors that would also affect asset growth anomaly or asset growth effect. So in this paper, we bring up two factors, which is individualism and uncertainty avoidance. Okay, so for US, the uncertainty avoidance is actually pretty low, I would say. I mean, pretty high because it's to the left. So in a sense, the US investors were many, as I said, US people, they tend to be more individualistic. But in the for the uncertainty avoidance index, they're, to the left. So that means that these two personality or these two culture aspects are not actually the same. So you can be individualistic as well as uncertainty avoiding. So those two are not, necessarily the same thing. Okay.
Yeah, thank you, Robin. I think while waiting for another question,
Okay.
actually, if we see, that this study is compelling because um, this will be of big interest not only to the academic realm but also to the practitioners, to
Mm-hmm.
corporate managers, because we see the combination between the cross-cultural management uh, reflected by the individualism and also uncertainty avoidance,
Mm-hmm.
and we see how the asset growth effect is really, or the asset growth is affected or is linked to the national cultures. But
Mm-hmm.
maybe I have one little question to you. Why is it considered to be an anomaly? I mean, the relationship between the national cultures and asset growth. I
Uh,
mean, your results are, yeah, quite making sense.
mm-hmm.
Uh, they also suit to the literature. Why is it still considered to be an anomaly? I mean,
Um,
this relationship.
okay. Uh, as I say, there are various arguments in the literature talking about whether asset growth effect is an anomaly or not. Okay, so in this paper, we're not trying to say whether it's anomaly or whether the effect is rational or irrational. What we're trying to do here is to show you that we find two additional factors that have significant explanatory power over asset growth effect. So I intentionally use the word effect instead of anomaly because an anomaly is controversial, right? If you think it is, then it
Mhm,
is. But people also think, there are some researchers, they think that asset growth effect is actually rational because managers invest when the future expected return is low or the future cost of capital is low. So that's the part we're not trying to, jump in because it's very controversial. But what we're trying to say in this paper is that because national cultures are well researched in the literature, but there have been no study linked national cultures to asset growth effect. So we would say, well, let's try it. But as I said, the paper, there's something missing in this paper because we haven't really tested whether the whether the uncertainty avoidance index and the individualism index are actually related to overinvestment itself. So that's the thing we're trying to figure out now, and we're working on it. So if we can establish the first link and the second, the relation between asset growth effect and national cultures will become naturally understandable.
mhm.
Okay. I
Thank you,
don't know
Robin.
whether I
Can
And
I can I ask the question, please, Pak Eddie?
okay, yes, yes, sure,
Yeah.
Professor Pandulini.
Okay. So I just want to ask first about the you choose only two national cultural dimensions.
yes,
The
yes.
first, why only two? Because I think you take from the Hofstede, right? The
Yes.
national cultural Hofstede.
Mm-hmm, mm-hmm,
Because we also have like a power descent, femininity, and the masculinity, right?
mm-hmm.
For the
Right.
cultural national cultural dimension. Is the first
Mm-hmm,
questions.
mm-hmm,
Why you only choose two dimensions?
mm-hmm,
Maybe you have some reason. The second one, uh, individualism countries, they tend to have over investment, right?
mm-hmm,
And the also the less uncertainty avoidance
mm-hmm,
cultural dimension will tend to have over investment.
mm-hmm, mm-hmm,
Okay, if we just try to relate to the because the over or under investment is related also to the agency theory, right?
Yes.
Yeah, because if managers, right, try to make an over investment because they want to gain from that, right,
Mm-hmm.
means that is in line, not in line with the principles,
Mm-hmm.
okay, in the some countries. So do you think this is also have some kind of this kind of theory, and if we can solve to reduce the agency problem, and maybe will have a different effect?
Um, okay. The first question is why we only use two factors. I know that you probably read those papers, the survey papers. So let me explain this. There's another factor called social distance, right? And I think there are like 8 or 9 national culture factors. But the thing is, so for example, like social distance, it's really difficult to come up with a hypothesis why social distance would affect firms' investment decisions.
Yeah.
So we try to follow the literature because uncertainty avoidance has been studied in finance and economics. That's related to risk taking, right? And risk taking is an important issue in finance. And the other one is individualism. Individualism is also well researched in finance. And people find that researchers find that people that are in more individualistic countries, they tend to be again, invest more or to be more risk taking, right? Or well, to be self-centered. So those two factors have been linked to finance and economics. And I agree. If we can come up with other good stories for other national cultural factors, then we can do another paper. But we try to, we couldn't come up with good story right now. So that's the reason, the simplest answer, right? That
Okay,
we
thank
follow
you.
literature to be safe and it's easier to explain.
Thank you.
Okay. And the agency problem, I totally agree. So if you know that your managers are overconfident, what would you do, right? You try to constrain their decisions in a certain frame. But on the other hand, if you put in too strong a restriction, it's really difficult for them to make the firm to grow in the future. So it's a trade-off. So there are other papers in the literature talking about, you know, early literatures, almost all papers that criticize overconfidence. They say overconfidence is bad for the firm, right? But the thing is, later research, for example, I think that's done by, I can't remember the author. They say, you know, uh, moderate overconfidence is actually good for innovative firms because moderately overconfident managers, they will be more willing to invest in R&D. They will be more willing to do innovative, investment. So if we are overly uncertainty avoiding, then you wouldn't invest in those high risk projects. So, later papers, they find that if managers are too overconfident, then that's bad. But if they're least overconfident, then that's bad as well. So the best manager you want to have for innovative firm is those that have just right overconfident, right? But next question is, how do you define
Yes.
moderately overconfident, right? It's another issue. It's almost philosophical, right? It's really difficult to quantify. So in those papers, the way they did it is try to separate managers into 3 groups, right? High, medium, and low overconfidence. So they find that the medium confident managers tend to have better performance only in innovative industry. So this is the so-called the agency problem you are talking about. So I find this area fascinating because, if you think about the behavioral side, actually behavioral biases are not always bad, right? It's a shortcut or it's a heuristic for people to make decisions quickly. So that's what we did every day, right? Would you think very carefully about what breakfast you want to eat? No, right? You just get up and eat something that you are used to. So that's behavioral bias, but that actually makes you make decision quicker and probably more efficient. Okay,
Okay, thank you.
thank you.
Yeah.
Yeah.
Thank you. Thank you, yeah, Professor Edward and Robin. So I think I will take some questions from people who have raised hands. I'll start from Inge. Yeah, I'll give an opportunity for Inge to ask a question. Please, Inge, is Inge here?
Maybe you just read ID because maybe they cannot,
Yeah, there's no more question from the Q&A
Okay.
chat room, but some people have raised hands. No Inge, then I will continue with Idam.
Oh, actually, there is a
Yes, Idam
question
Lakoni.
in the Q&A.
Okay, please
Oh
answer.
yeah,
So
just
affirm
came
that
up.
the last risk taking.
For attendees who wish to ask question, please refer to the
Yeah,
Q&A chat box so you can type your question there and then get it answered by Prof. Robin. Thank you.
that's right. Yeah.
Okay.
I mean, some people raised hands but didn't want to talk this time. So, by Eddie Gunawan, a question by Eddie Gunawan. He has
Okay.
thought he has uh,
Less
that
risk
the
taking, low
paranoia.
considering will actually tend to overinvest. Yes, yes, that's what's found in our
Mhm.
paper. But Eddie was thought the opposite because paranoia or voting risk will make the firm overinvest. I don't understand. Avoiding risk. Now, if you're avoiding low, okay, if you're low uncertainty avoiding, you'll be actually more willing to take on risk, right? So you're not avoiding risk. You are taking more risk. So if you're taking more risk, then you tend to overinvest, and the investment will be tend to be unsuccessful. And this is the behavioral bias coming in, because people just don't learn from past experiences. That's why the behavioral bias will still be significant, right? Okay, so sorry, I mean avoiding uncertainty. Yeah,
Oh,
right.
uncertainty avoidance.
Yeah,
Yeah.
uncertainty avoidance index is okay. When uncertainty avoidance index is higher, that means you are more uncertainty avoidance. Right? So if you are more uncertainty avoidance than avoiding, then you tend to invest less because you're just risk averse. Okay. So if you invest less, that's actually good for the firm because you tend to invest more efficiently, and the tendency to overinvest is mitigated. So that's why the asset growth effect for uncertainty avoidance index is exactly opposite to individualism index. So let me show you the results again. I don't know whether it's probably okay. Let me show you the slides again here. Okay. Let me explain this again very quickly. This is the individualism. So what you can see here is for firms that are in high individualistic countries, okay, the AG10 are the firms that invest the most that experience lower returns. So the difference will be positive, right? And the difference in difference will be positive. These slides talk about the difference between high and low individualistic firms. So as you can see, 0.745 is the difference between high and low individualistic countries. So the asset growth effect is very significant for high individualistic countries. That's the basic conclusion here. Now, for the next slides, the results are exactly the opposite, right? For low uncertainty avoidant firms or countries, firms in those countries, when the firms invest more, they experience less return or lower return. When they invest more, they experience lower return. When they invest less, they invest more efficiently. But the thing is, the important point to take away from this slides is the difference between high and low uncertainty avoidance firms. You can see here the results are exactly the opposite to individualism. I'm sorry, there's a typo here. This should be this is UAR. I'm sorry about that. I didn't change the title. This is uncertainty avoidance index and asset growth anomaly. So the
Okay.
basic idea is that individualism and uncertainty avoidance work in the exact opposite way. And it's a bit confusing when you look at this UAI. The way to think about it is that for firms located in low uncertainty avoiding countries, the asset growth effect is stronger or the strongest, right? Is in the contrast to firms that located in high uncertainty avoidance firms. In high uncertainty avoidance firms, the asset growth effect is not significant. So this is exactly the opposite to individualism results. Okay. So I don't know if I explain things
Yeah, I
clearly,
think yeah,
but
it's quite clear. Yeah.
okay.
Thank you, Robin. I think he has a continuation to the previous question, but I think
Okay.
he has another perspective. Like he's thinking that the uncertainty avoidance, like when he doesn't like uncertainty, he would overinvest. I think this is like an exception or a particular situation because he's thinking otherwise.
Mm,
Like people
mm-hmm.
with higher uncertainty avoidance will tend to overinvest. I mean, maybe it's not common. Also, it doesn't fit to
Okay.
my a common thought, but maybe there's an exception or a spectacular
Yeah.
situation that makes
Okay.
people to be
Okay.
like this.
That's I don't know. Intuitively, I would
Yeah.
say if you're low uncertainty avoidance, that means you can take on more risk, so you tend to invest more. That's
Mm,
my
mm,
perception.
mm.
But I don't know.
Yeah,
Maybe
that's common
you know
perception.
we need to establish
Yeah.
the link. As I said, we need to establish the first
Mm,
link that we haven't done yet. We
mm-hmm,
need to actually test the link between uh,
mm-hmm.
individualism and UAI and overinvestment first, and then we can carry on with our stories. So now it's like we jump to the second part of
Yeah.
the story without clearly show people that the first
Mm,
link is there. We only rely on the literature,
right.
and that's true.
Right.
You can always criticize that you
Yeah.
didn't really show the clear
Uh,
results or evidence on why UAI and individualism are related to overinvestment. Yeah, we'll take that criticism. Yeah, yeah.
Thank you, Robin.
Robin, maybe yeah,
Um,
okay.
yeah.
Eddie, just I want to add
Yes.
little things, right? Like the country with the you know high uncertainty avoidance or maybe low uncertainty avoidance.
Mm-hmm.
Okay, and how about if the manager is overconfidence? What do you think?
So, say it again, please.
The manager are
Mm-hmm.
overconfidence.
Mm-hmm.
Do you think that it's also affect the because we study also about the overconfidence
Mm-hmm.
of the managers, right? And the overconfidence tend to also have the over investment. So what do
Yeah,
you think when you are studying?
that's what we're trying to propose. If you're overconfident, then you tend to invest more, right? Because you're pretty sure that your project will be successful. So in the literature,
Mm,
the model that have been proposed in the literature is that the overconfident managers they usually overestimate the successful rate of their projects and the expected returns, future expected returns of their projects. So that's why they are more willing to take on new projects or even merge with other firms. So Momenty and Tate in two papers they talk about overconfident managers. They tend to invest more and tend to initiate merger acquisition deals more frequently. And if they start merger and acquisition deals, the probability of getting it done is also higher for overconfident managers. Okay.
Okay, thanks.
okay.
Thank you.
Yeah. Thank you, Robin.
Yes.
The next one, I'll give a chance to Desi. Desi Femilinda Safitri. She raised her hand.
Miss
Yeah, please
Desi,
unmute
please
yourself
unmute
and
the microphone
yeah,
to give the question.
yeah. So no, nothing. So
Maybe because they cannot
yeah.
mute, right? Yolanda, because
Yes,
I
yes,
think,
they
yeah,
can,
because
Prof.
it's already said already
They
set
can.
by the admin, right?
They already
The host.
they're able to unmute
They're
their
able. Okay,
microphone.
so
Yeah,
they're able,
Yeah,
right?
we have changed
I
the setting.
enable. Yeah, I
Yeah.
enable it. I enable it. Yes. So maybe from other panelists, if you have questions
Uh,
to Robin,
can I
we
go
still have
back to
some maybe 10 minutes
Eddie's
or so.
last question?
Yes,
Okay. Eddie
yes,
says that
yes.
if I don't like uncertainty, so I overinvest to avoid uncertainty. I think that's the opposite because all investments are risky,
Mm,
right?
mm,
So the safest, if you
mm.
don't like uncertainty, then you'll keep your money in closet. That's the safest way to guard your money, right? So every
Yeah,
investment would have, risk. So if you don't like risk, don't invest. That's the idea. Okay.
that's right. That's right. That's right. Yeah, that's right. But I think what you explained was very important. I mean, if you have the test, the
Hmm.
preliminary test that shows the relationship between the investment itself
Right,
with the national cultures,
right.
then that will prove everything.
That's
There
right.
will be no more, debate on this, on the other
Yeah,
side.
yeah, John, you're right. So that's what I said. The first link is
Yeah,
missing, so it always brings a lot of
yeah,
questions. Why, but
yeah,
problem is that investment data is somewhat difficult to obtain, and the Momentian paper, they don't directly look at how overconfidence would affect overinvestment because overinvestment itself is very difficult to define. What's over, what's under, what's just right. It's really difficult. So what they did in their paper is to look at how overconfidence would affect the cash flow and investment sensitivity. Because from theory, investment and current cash flows should have no relationship, right? Because if you have insufficient cash, you raise capital to invest in positive NPV projects. Now, if you have a lot of cash, you don't invest in negative NPV projects because you have too much money, right? So theoretically, current cash flow and current investment should have no relationship. But what's found in the literature is that current cash flow is highly positively significant related to current investment. So that means managers try to invest more when they have more cash and try to invest less when they have less cash. And why is that? Because if you don't have enough cash, and you are overconfident. You don't like to go to the market and raise capital because you always think the cost of capital is too high, right? Because you have confidence in your firm, so you always think that the cost of equity capital and cost of debt capital is too high for your firm because other people don't understand that you're so good at manager. So you tend not to raise capital when you don't have cash. Now, what about if you have too much cash? Then you tend to overinvest, right? Because you're overconfident yourself in your own ability. So when you have more money, you'll be more willing to invest. When you don't have money, you would be hesitate to raise capital, outside capital, so you invest less. So overconfidence is probably a driving force between the sensitivity of cash flow and current investment. So what I'm trying to explain here is that even Momentum take in the their paper, they didn't go on the track of directly testing overconfidence. Instead, I'm sorry, overinvestment. Instead, they test the relation between cash flow investment and how the sensitivity of cash flow investment is related to overconfidence. And they find there's a clear link between overconfidence and the sensitivity of cash flow investment. Okay, so story is a bit long, but to put it in short, that's the first link that's missing in the paper, and certainly we'll try to amend it and put it up.
yeah.
So the more
Thank you,
questions.
Robin. And actually, yeah, actually, we have one
Mm-hmm.
more question from Mayang. Mayang Dewi
Okay.
Indrawati. She's saying, do you think the research results will portray the index or indexes of stock exchanges in different countries? And do you think one of the anomalies on your research is the government policy factor?
Okay. The first question is, do you think the research result will portray an index of stock exchange in different countries? I don't really understand this question, but if you're talking about the index of stock returns among different exchanges, uh, then you would you wouldn't be able to test the asset growth effect because for asset growth effect, you need to have firm level data. But if it's a market data, you don't have, uh,
Mhm.
it's not, it's impossible to distinguish between returns among different firms. So, but if you're talking about whether national cultures would affect returns of different stock markets or stock exchange, then that's possible. But I don't know how to test it. You probably want to come up with hypothesis first. So, for example, one thing comes to mind is that is it possible that uh, countries that are more individualistic, then their stock markets tend to fluctuate more or tend to be more volatile? That's possible, you know, because in Taiwan, we're always joking that Taiwanese people like to gamble. Right? So the stock markets fluctuate a lot. So if you want to come up with something like that, I think
Yeah.
that's interesting. But for firm level data, I don't think that would work. As a growth effect, it won't work on the stock exchange level. Okay. And the second question is, do you think one of the anomaly on your research is government policy factor? Um, I don't really, uh, I don't fully understand what you refer as a government policy factor. But if you're thinking about like tax law changes or dividend law changes, that's possible. But that's more like a exogenous shock to the system. So if you think the research has some sort of endogeneity problem, then government policy factor is always a good event because government cannot be, well, is less likely to be influenced by firms, and government policy would affect firms very significantly. So for the asset growth effect, I haven't seen any paper talking about government policy. But if you want to, you know, give me a few examples about what kind of government policies you're talking about, then I can probably, get back to you with more of my thoughts. Okay. Okay.
Thank you, Robin. Maybe in some situations, um, I mean, I'm trying to interpret what Mayang tried to say. I mean, maybe in some countries, um, they have like certain ethnic
Mm-hmm.
cultures or more natural cultures, but because of the national which are contrary to the national
Mm-hmm.
cultures, the people might behave differently.
Mm-hmm.
We could say, for example, the between the South and the North
Mm-hmm.
Korea.
Mm-hmm.
North Korea are Koreans, Asian people, but because they're using more extreme type of
Mm-hmm.
socialism, maybe they behave differently or something. But maybe this is an exception as well, like what AD Gunawan
Okay.
tried to ask as well. But what do you think about that?
You mean the Eddie's new question?
I mean, Mayang, I mean,
Mm-hmm.
from what I interpret Mayang's
Mm-hmm.
questions, maybe she is observing that there are some countries with certain national cultures, but they behave differently because of national
Mm.
regulations or national policy in general, like
Okay.
socialism or something.
Okay. Maybe.
Maybe that could happen.
Yeah, that could
Yeah.
happen.
So,
So the government
mm, mm,
policies or government regulations could be additional controls. And what we
yeah,
have in
yeah.
our paper is legal region that's pretty
Mm,
close to what you're
mm,
talking about. But yeah, as I
mm,
say, it's the idea is actually very interesting. I show you the figure. There's so much variations in asset growth anomaly among different countries. So our factor can only capture some of them, but there are still a lot of other things that you can come up with and potentially can explain the asset growth effect in an international setting. So government policies would be possible factor, but I don't know yet. Yeah.
Thank you,
Yes.
Robin. Maybe one more question, if any, before I wrap it up.
I think Eddie has another question. Did you see it?
Uh,
1109.
yeah, the previous one. I think this was again a
Yeah.
continuation to his previous ideas.
Okay.
So
Yeah. Let me reply shortly. I mean,
yeah,
the thing is,
mm,
I
mm,
think the example that you give is not exactly what we're trying to figure out here because we're talking about capital investment. So, for example, firms will will invest in capital projects to make profits, not to protect yourself, right? So, I think the basic idea is a little bit different. You invest to make profits. So high risk, high return. That's in finance terms. So no risk, no return, low risk, low return. So the example that you're giving is to invest in protective instruments. That's not what I'm talking about here. Okay, that's a different. I think that idea is interesting, but it's a different topic,
Mm,
I would say.
mm,
Yeah.
mm, mm. Yeah, thank you, Robin. Yeah, I think what Eddie is saying also shows that the nature of research is about generalization.
Yes.
There will always be some
Mm-hmm.
exceptions, some different thoughts or some different practices every now and then. But again, the nature of research itself is to generalize. I mean, we talk based on data or based on I think the majority of cases or
Yeah,
situations.
that's
So
right. That's right.
that's
Yeah.
very interesting. Yeah,
Thank you.
yeah. Thank you,
Okay.
Robin,
Thank
and
you
thank
so
you
much.
to all attendees who have asked questions, who have raised hands but didn't want to talk. But so thank you very much to all of you, to all the panelists as well. I think I'll hand it back to Tantiana. But again, thank you for this previous this um, privilege
Hmm.
that we could see Robin, Professor Gondry, Professor Edward, Professor Irwan, and all the panelists and attendees here.
Yeah.
Thank you and see you next time.
Thank you
I
so
Yes,
send it
much.
back to Tantiana.
Hopefully we'll see you in
Thank you.
person next time.
of
Sure.
Okay.
course.
Yeah. Take
Okay. See
care.
you. Bye bye.
All right. Thank you so
Bye.
much for Mr. John Eddie Jonarsin for moderating, and also for thank you for Prof. Chow for presenting your research. I'm sure that it has given interesting insights to all of us in the conference here today. And after this session, we're going to have IFA session first, and then continue with break. And after that, we will have parallel sessions as scheduled on the guidebook provided. So for the IFA session, please welcome the board of IFA. Probably Prof. Ted will start.
Okay, thank you, by Yolanda. Maybe I will show my slide first, right? Let me, okay. Can everybody see the slide?
Yes.
Okay, so this is, I just want to uh, show you the journey of Indonesian Finance Association so far, right? So, okay, this is the Indonesian Finance Associations, right? This is the non-profit organization established to cultivate a strong networking among academics, business regulator, and financial expert in Indonesia, especially in the realm of corporate finance, capital market, international finance, and financial institutions. So in this session, I will, you know, discuss with the all participants and also all speakers, and maybe some of you already become a members of Indonesian Finance Associations. Okay, if you still not a member, and officially today you are become a member, because automatically when you join the IFA, okay, conference, and you are become a member of Indonesian Finance Associations. The next, okay, this is the Professor Iwan as a president, and I'm a chairman or chair of the advisory board. Okay, and also we have Irwan Triguno from Universitas Sebelas Maret as a vice, okay, president of the program of international relation, and also Mamdu Hanafi, Vice President for Membership and Administration, and the last one, Vice President for Research and Activities and Cooperations, Dr. Safri Husodo. Maybe I just want to mention uh, 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 Mamdu Hanafi just got the professorship, right? So now it's become a Professor Mamdu Hanafi. Okay, and you can see here, actually IFA was initiated by three business school in Indonesia from Universitas Indonesia, Faculty of Economics and Business, from also Universitas 11 Maret, and of course from Universitas Gajah Mada. Okay, so at the time, I think back in 2015, okay, we meet several times and we decide to establish the Indonesian Finance Associations. Okay, and this is a non-profit organizations. So we are happy to invite all the academicians, professional to join this Indonesian Finance Associations. Okay, so we sorry. Okay, so the first IFA first conference in 2015 hosted by Faculty of Economics and Business Universitas 11 Maret in Surakarta is very close to Yogyakarta, actually only 1 hour from Yogyakarta. And IFA second conference held in 2016, hosted by Faculty of Economy and Business Universitas Gajah Mada here in Yogyakarta. And the third conference, sorry, should be 2017, hosted by Faculty of Economics Universitas Indonesia. And fourth conference in 2018, hosted by Faculty of Economy Universitas Lampung in Sumatra. And the fifth conference in 2019, hosted by Faculty of Economics and Business Universitas Samratulangi. This is in Sulawesi, North Sulawesi, far from Yogyakarta. It's like 3 hours flight from Jakarta to Universitas Samratulangi in Manado, North Sulawesi. And of course, today conference, sixth conference, sorry, should be 2020, right? 2020, hosted by Indonesian Stock Exchange like we have right now here. Okay, so, okay, we hope that every year we will have a conference and we will invite all the academician and professional to join the conference to present their paper so we can exchange, right, from the academician and from professional practitioner, right, to come together and share our view about that what happened in the theory side and what happened in the practical side. So this is actually the main. So in this meeting, I hope that maybe, right, everybody can share or maybe give some suggestion what actually we want, okay, the IVA, right, in the futures. So can help or also contribute to the academician and also to the professional. So our mission is enhancing Indonesian financial scholar contribution to international academic landscape and participating in advancing the financial literacy and policy in Indonesia. Our objective, fostering the networking among members, promoting its members' experience and personal development, and improving knowledge in financial field. And of course, we also hope that we can have publishing in top tier journal based on robust and religious methodology for our paper. So this is actually about the mission and the objective of Indonesian Finance Associations. Okay, and this is just a documentation of some event that we already held before, right? So start from the first in uh, Universitas 11 Maret, and the second in Universitas Gajah Mada, the third in Universitas Indonesia, the fourth Universitas Lampung, and the fifth Universitas Samratulangi, and today, of course, hosted by the Indonesian uh, Stock Exchange. Okay, we have a problem at the time, right, when the COVID come, because we have two choices. First, we want to cancel the program, or we still continue. Okay, but finally we decide to continue, but we change from a physical, uh, 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 come together, right, and meet together physically, but we decide to have the online conference. So that's why today we have a online conference. So this is actually we can see from a previous event that we already have. So now I invite everybody, if you have any suggestion for Indonesian Finance Association, we have about 1 hour before we break for Friday prayers, okay? Because today Friday in Indonesia, so we will finish uh, 11:30, okay, for these sessions. We call the IFA sessions, okay? So this is also for the networking. If you have any suggestion, question about the Indonesian Finance Association, I'm very happy to to answer. Okay, and also here I invite some of the board members. Okay, and also Pak Mamdu if here. Okay, Pak Safri and Pak Irwan Tri, and also Pak Irwan Ekaputra of course have uh, program with the LPS, right? Indonesian Depository Agency. Okay, so if you have any questions, so I just maybe so I can see everybody. Okay, so now please, if from all participants presenter, if you have any suggestion also about the IFA, so we can maybe improve and serve more to the members, right? From the board, and also from maybe I can also give some. We have a secretariat in Yogyakarta. Okay, we have a secretariat here in the building of our Master of Management program in Yogyakarta. We have one rooms, and also we have one uh, okay secretary to serve you. So if you have any question, or if you want to know something, and if you want to have a membership certificate, you just contact us. We will send you the electronic membership certificate. Okay, all everybody for free, because now we want everybody to join, and later on maybe you have to pay a member fee, right? But
Mhm.
right now we still have no member fee. Okay, and we can run this organization, okay, because after the conference we hope we have some money left, so we can use the money to run the organization, because we don't have other income so far. We don't have other income. Just when we have a conference, usually after we finish the conference, we hope that the money that come from the sponsor, we still have left some money, and this is the money we use for run this program. Okay, so this is about the IFA. So if you have any suggestion, please.
If anyone has any suggestion,
Yeah,
probably they want to raise their hand, and then we will let them speak for the conference. Or maybe other board members would like to say something, Prof. Ted?
yeah. Maybe from a board member is here. Okay, please. Irwan still here or already joined the LPS? I don't know.
Still here. I'm joining both actually.
Okay, both. Okay, Pak Irwan, if you want
Parallel.
to, if you want to say something, yeah, the president.
First of all, I would like to say thank you for everybody for joining this conference. As Prof. Ted already mentioned, that you will be automatically registered as the member of the IFA. But probably if we forget to, if you need your certificate, please email us. And we have a person who is in charge for that is Mbak Anissa. I think she's in the, I don't know whether she's in the panelist, but I saw that she has sent some messages through
Yes.
the chat. And probably Mbak Anissa would like to like create some list through certain link so that the new members can register and probably also share the email of IFA email, whereby if anybody wants to get a certificate, they can just email us. Yeah, your support means a lot to us because this organization is from us all and for all of us to enhance our finance capabilities as for academics as well as for the real sectors of the businesses and also for the networks between businesses and academics. I think that's for me. That's all for now. Thank you.
Thank you, Prof. Irwan. Prof. Ted, there is actually a question from the Q&A box.
Yes.
Is there any plan for the next conference? The host, who is the host of the conference? Who's going to be the host? Do you have any plans,
Yeah,
Prof?
we haven't decided yet because usually some university they will send us the proposal that they want to be a host for the next conference, right? But until now we haven't decided. Of course, there are some proposal already, uh, we already have, but haven't decided yet. Okay, even this morning, Pa Irnano mentioned that let's make it next year again in Bursa Efek Indonesia. Right? Okay, Pak Irnano said, but let's see because we still at the time, okay, before COVID, of course, we already prepare everything that we will have a conference in Bursa Efek, right? So everybody can come in the Bursa Efek Indonesia in Jakarta, Jalan Sudirman. But unfortunately, the COVID come and we have to decide, right? Have a conference to the online, right? So maybe next, yeah, we haven't decided, but maybe if the conditions become better when the COVID-19 okay pass, and maybe we can come again to Bursa Efek Indonesia and meet there because we already discussed about the room, we already prepare everything actually, right?
Mhm.
But we don't know, right? Suddenly the COVID come and we have to decide, right, to have this kind of conference.
That's
Okay,
true.
so we haven't decided yet. Okay.
Okay. Thank you, Prof. Ted. Actually, Miss Inge Barlian has been promoted to panelist. Maybe you can unmute and turn on your video to ask questions or probably have some networking. Please, Miss Inge Barlian. Hello, Miss Inge. Are you there?
Yeah,
Maybe
I think
she's
it's
too
still we
shy.
yeah, we okay, no problem, right? If you feel convenience to speak in Bahasa doesn't matter, right? Doesn't
That's
matter.
true. Yeah.
Yeah. Okay. Because this is not our language. Don't worry about that.
Mhm.
Because whatever I attend the other conference about usually also the same things, right? Okay. So please, if you feel more confidence to speak in Bahasa, please don't worry about it. Okay, Pak
Okay.
Edi Gunawan, I think is
Wait.
I
Let
don't
me
think
see.
I think from the host maybe I mean they cannot unmute. Yes, still
We have
unmute.
we have
Yeah, we
already
enabled it. Yeah,
yeah,
we
we enabled
enabled
it
it.
Yeah, they
already.
Mm,
unable, right? Yeah,
mm.
because so far it's difficult for me to hear from them. Okay, please let's see in the chat, yeah, in the chat what they say in the chat room.
Yeah, maybe Eddie Gunawan, Eddie Gunawin.
Would like to say something probably.
Yeah, Edi Gunawan, you have a lot of questions. Please.
Okay, we're going to promote him. Okay, already. Okay.
Yeah.
Maybe you can
Okay.
turn on the
Yes, it's
video.
working. I just want to try to
Sure.
see whether you can whether the attendees can unmute. So
Yeah, you
it's
can.
working. Yeah, that's okay.
Yeah,
I just want to say that it's a very good conference. Um, I would suggest that, even though we definitely hope that the COVID will pass, but in the future, the conference should also have the online version so
Yeah.
that people who cannot travel to Lampung or Surabaya,
Mm,
I would love it if it is in Bursa Efek Indonesia again, because
yeah.
I'm in Jakarta. But if it is, on another city, then at least if you have the online version, then people can join as well. So just a suggestion. Thank you.
Okay,
Thank
Pak
you.
Edi, what's your institution?
I'm actually a listed company. I'm from Super Crane, uh,
Okay, okay, from a
Tama.
listed
Yeah,
company.
we are crane rental company.
Okay, thank you.
Thank you.
Yeah, I think it's a good idea, right? Because in the previous conference, if suddenly the speaker cannot come, and usually we just try to use the Zoom or others media, so they can still present their papers, right? I think as a good idea, maybe we can mix, right, between if they can come and also if they can present, like for instance, especially from other countries, sometimes it's difficult, right, to get a visa, and the other thing is also maybe too expensive for them to come to Indonesia. Okay, so I think the good idea, I mean, in the next conference we can mix. If we already can meet, right, but we still can use the online presentations. Okay, and also we can use the Zoom, so some of them also maybe can just follow through the online.
Yeah.
Okay, in the futures, I think. Right.
Yeah.
So thank you,
That's
Heidi.
a really good idea, Prof, to
Yeah,
have it both
yeah,
virtual and also physical, probably in
yeah,
the near
yeah. I
future.
think so. Yeah.
Yeah. There is also another question from John Sham. The question is, how is your membership divided between academics and practitioners? As for practitioners, is it mainly bankers or does it include corporates?
Okay, maybe Pak. Okay, the Pak Mamdu is here because Pak Mamdu is the the vice president for the membership. But if not here, and I will answer.
Yeah, I'm here, but
Oh yeah, yeah, Pak Mamdu, can you answer Pak Mamdu?
uh, we trying to formulate the membership policy. So far, I think the membership is just individual membership. In the past, we thinking about the institutional membership, but so far we haven't activated that feature yet. Let's say this feature. So individual membership. So I think since we want to cover both the academics and professional. So I think we welcome uh, we welcome both the academic and the professional. our main activities so far mostly academic, like annual conference we have today. But in the past, probably we're going to have, or we would like to have collaboration with the professional, because the academic is not going to be in the, what do you call, ivory tower. And then
Yes.
we're going to also go to the field basically. So we like to collaborate with the professional world. But probably since our route is the academic, what do you say, the academic community, so probably the academic activities probably still the main activities of the institution, but we like to extend to the professional world. So yeah, I think we will welcome the membership from the professional. I think that's and the policy for the membership keep changing. I think probably in the future, in the near future, we going uh, to set up more formal membership policy as well. This that we're going to have some discussion on the memberships. So far, our membership is still free membership, so everyone can be membership. Everyone can join this association, and then we welcome collaboration from others, from professional. So let's make this institution, the association is ours, not only us, but ours. Not only
Okay.
me, not only Pak Ted, not only academics, but probably also all people. I think yeah, that's from me, Pak Ted. Thank you.
Okay, thank you, Prof. Mamdu.
Thank you so much, Prof. Mamdu. The spirit is there. So the association is actually for everyone who wants to join. And there's also another question from Mr. Berto Usman. He asks if there is any special membership price or discount for PhD or master student. Prof. Ted.
So we still don't have
Membership fee.
membership fee. So if you want to pay, it's all right. Right?
That's true.
You donate, so do not donate something. Yes, okay, right?
Donation
So
is
far,
all
yeah,
always welcome, yeah, Prof.
yeah, welcome. Yeah.
Actually, so it's still free, so everyone can join. Maybe Miss Anissa in the chat box has already sent the links for the materials for the conference. So maybe if you want to download or look at the materials, you can go there to the link. And there's also another question in the chat box, Prof. How often the association member will meet? Do you have any routine meetings between the members?
The members actually only once a year, right, during the conference. But for the board members and also small group, usually we have a meeting. Like for instance, sometimes we also have a workshop program, and we discuss about the issues in methodology, research, right? Especially in finance. And also we will have a workshop for the current issue in finance, right? And we invite, but they have to register. And for this, sometimes we have to ask them to pay. Right, because it's not free, right? And the money actually come from these activities, right? So we can run this organization. And maybe I want to add some things, right? If you can see here, we have a logo here. So every, right, institutions or university become a host, automatically every conference will be put the institution or the university logo in our conference. Like we have, in your virtual background, we have Universitas Gajah Mada, we have Universitas Indonesia, Universitas 11 Maret, Universitas Lampung, okay, and Universitas Samratulangi, and Universitas Surabaya, because as a sponsor also provide us with the Zoom meeting for the parallel session. So we put the logo there. Right, so you can see there, right? If you become a host, and of course the next conference, your university will be there.
Of course, Prof. That
Yeah.
there is also another question, actually a suggestion from one of the attendees about IFA association. Probably they could have a WhatsApp group, probably for good or valid information about economic issues. Probably there is a suggestion, Prof. That.
Okay, let's see if yeah, because now it's very easy to communicate if we are in the WhatsApp group, right? I already have I don't know, right? More
Countless.
Great.
than
Thousands of group.
more than 30 WhatsApp group,
Yeah.
right? Because all like when I have a class in finance, also I ask students to
To make a WhatsApp
yeah, to
group.
make the WhatsApp group so I can communicate also easily with the student, I think, right? So let's see, we consider to have, yeah, the WhatsApp group, IFA WhatsApp group also. So I don't know, for the WhatsApp group, it can be up to how many,
Yeah, there's a limit
and,
on how many members,
yeah,
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 in
it's
one
a
WhatsApp
limit
group.
also, right? It's not
Yeah,
unlimited, right? It's the
yeah,
limit also, right?
that's true.
Mm.
Okay. Is there anything other board members wants to deliver or wants to add? Probably we still have a few more. Um, we still
Yes,
have time,
actually,
actually.
our dream in the future, actually, we want to provide the database, right? Because we know, like when we conduct the research, right? And sometimes the data that we already collect, okay, it's not easy, right? You can see because this is not like data about the stock market that we easily to get, right, from the Indonesian stock exchange, for instance, right? Some data maybe we have to collect one by one, and after finish the research, we just throw all the data. I think if the data, you can just provide the data for the IFA, and we have a database.
Mm-mm.
So for the researchers, if they need the data, they just contact the IFA and we will provide the data, right? Actually, this is our dreams. But so far, okay, we only still have a few data in our database. But please, if you think this is very beneficial for us, right? For the researchers, for the student, for the academician. If we sometimes we have a difficulties, right? When we want to conduct the research, we have a problem about the data, and the other person we do the same thing. Actually, the other already, right, done the same thing, right? But when the new researchers need the same data, okay, she or he will, right, go and do the same thing, collect also the same data, right? And it takes time. Okay, so if the data you have, you just send to us, and we will put in our database. Okay, so when everybody, at the same time also about the journal, because we now have the electronic journal, and sometimes when we want to find a certain journal, may be difficult. So by doing, we have a media like you can just through the IFA, and let's see if, okay, IFA can provide the journal that maybe you need, right, for your research, right? Or maybe we can communicate to the other members if they has, and of course we can exchange, right, the journal, right? So okay, make everybody, easy to get the journal. Okay, we try to help each others if you need the journal or also some a data that maybe is very important but it's difficult to get. Maybe
Yeah,
it's this, yeah, right? So
yeah, that's
this is
true.
our dream in the future.
To make it accessible for everyone
Yeah,
to
yeah,
access, yeah,
everybody,
Prof.
yeah, to
Yeah,
access the data.
yeah. We have actually promoted Mr. Berto Usman as panelist because he raised his hand before. Maybe Mr. Berto can unmute and also turn on the video so we can see your face and communicate with Prof. Ted and also other board members, please.
Thank you, Miss Tantiana. Good morning, Professor Tandelilin.
Good morning.
All right, thank you so much for organizing this very interesting conference program, and thank you to Indonesian Stock Exchange for welcoming us, all the academicians and also the practitioners in the accounting and finance field. If you don't mind, I would like to suggest one thing.
Okay.
So maybe I participated in several doctoral colloquium programs during my PhD a couple of years ago. Maybe it could be useful to be implemented in our international conference program next year, maybe, or the years ahead. What if we organize the conference? So, as now we have only 2 days, right? Probably we can organize for 3 days, and for the first days, maybe we can welcome the young early stage of scholars such as the PhD student in the first year, second year, or master students who have no clear idea what they are going to do about their research, and maybe they only have the idea but not the complete version of draft of their thesis of dissertation. Maybe the board member or the senior academics can help them to improve their work. So maybe for 3 days young scholars. So in the second and the third days, so we can be more focused on the ready or the complete papers to be presented, and we can gain more useful feedbacks from the attendees and the participants. But this is just my suggestion. Whether it is possible to be conducted or not, for sure it depends on the editorial board of IFA decision. So that's it, my point, Prof. Tandelin. Thank you very much.
Okay, thank you. Prof. Irwan, maybe you can answer. Prof. Irwan still here, right?
Yes, I'm still here, Prof.
Yeah, yeah, Prof. Irwan. Please.
Sorry if my connection is a bit unstable because I'm running two computers. Okay. Anyways, thank you very much for the suggestion. And I think it is a very good suggestion. It is quite possible to do doctoral colloquium before the annual conference or annual meeting. And as you suggested, you are rightly pointing out that a lot of upcoming young researchers, including PhD students, who also need some inputs on their early work or early ideas. I think it's a very good idea, Prof. I think we should try to implement next year and organize a 1 day longer conference. That's my take on that.
We
Thank
used to
you.
have, I think, I'm sorry, can I add? We used to
Yeah,
have
okay,
the
please,
doctoral
Pak Mamdu.
colloquium. I remember when we have in Lampung, in Jakarta, we have doctoral colloquium. So sometimes, somehow, sometimes we have on, sometimes we are off, something like that. So somehow this year, this program is off. So I think the issue is how to make it permanent, Robi, every year. Yeah, I agree with the Berto's suggestion. So we try to make it permanent every year. When we have the conference, we're going to have this doctoral colloquium. Yeah.
Okay, thank you, Prof. Mamdu, and also Prof. Irwan for the answers, and also the we have received the suggestions for IFA and also the conference next year. Probably it can be taken into consideration for improvement as well for the conference next year and the years ahead. Let me see. There's also another participant who we have been promoted to as panelist, Mr. Idam Lakoni. Maybe you want to add something or you want to give suggestions, please, Mr. Idam. Mr. Idam, are you there?
Maybe problem
Hello.
with his mic. Maybe.
Probably. Yeah,
Yeah, probably.
that's true. Yeah. Hello, Mr. Idam. It's
Yeah, he
I
has
don't
raised
think.
his hand since the first session.
Yeah.
Yeah, I didn't talk. Yeah.
We want to give opportunities if he wants to say
Mhm.
something to the conference, but he hasn't answered yet. I don't think there is any answer from Mr. Idam Proftet. If you want to add something or you want to close or any closing statement for the conference, please go ahead.
I see a question in the chat.
Oh, in the chat. Wait.
The
Sure, Prof.
logo
Irwan.
is it IFA
Yeah.
or AFI?
Yeah.
Okay, from Syahri to Asiregar. Okay, I think I would like to answer that question. The Indonesian version, the name is Asosiasi Finansial Indonesia, so hence the AFI. But the English version is actually Indonesian Finance Association, so it's IFA.
Yeah.
But we still go with the AFI
Indonesian
until now,
logo. Yeah.
the Indonesian logo. So that's the answer. Thank you.
Thank you, Prof. Irwan. Um, I don't think we have any more questions, Prof. Ted.
Yeah, if no more question and we can end our IFA, okay, session, because it's a Friday, so you have more time to prepare for Friday prayer. Okay, praying, and I think we will after that we will go directly to the parallel session, right?
Yeah,
Okay,
it starts
okay,
at around 1:30. Yeah.
okay, 1:30. Okay, thank you very much, and okay, see you again in the parallel session. Thank you.
Thank you, Prof. Ted,
Thank
also.
you.
Thank you.
Thank you. And
Uh,
after
Thank you,
this,
bro.
all the participants and also attendees may have a break first until 1:30 p.m. Indonesian time. And then you can proceed to the links provided in the guidebook and continue with the parallel sessions that you wish to attend to. And at the end of the day, you may come back to this plenary room again for the award and also announcement for the best paper, which will be announced by Prof. Ted. And before we close the plenary session today at the second day of conference, maybe we can have another group picture for the second day.
Yes.
Yes, it's a
Yes.
favorite for everyone.
Okay.
A photo
Yes.
session, probably the formal one first, and then we can have another pose for the photo session. Okay, maybe everyone can turn on their camera, all the panelists. Turn on the camera. Okay, 1, 2, 3. 1, 2, 3. Okay, and the second pose would be thumbs up. Oh, Prof. Robin, are you there? Prof. Robin Chow?
It's not there.
He's
Yeah.
not here yet. Probably he's away. Oh, okay, here
Yeah.
there. Okay, we're gonna have a photo session, Prof. Chow.
Okay,
Okay, second pose would be thumbs up.
thumbs up.
Yep. Okay, 1, 2, 3. 1, 2, 3. Okay. Okay, thank you so much for everyone
Mhm.
joining in the second day conference of Six International Indonesian Finance Association International Conference. We thank you for your participation until today, and thank you and have a fruitful sessions today, and have a good day ahead of you. Thank you.
Thank
Thank
you very
you.
much.
Bye
Thank
Thank
bye.
you,
you. Bye.
Tatiana.
Thank you.
Thank
Thank
you,
you
Yeah.
so
everyone.
much.
Thank you.